I'm joined by Joe Davis, Vanguard's global chief economist and head of investment strategy. Joe, it's great to have you here. You think wages will dictate what the Fed does this year, is that right?
Yes, and thanks for having me. Again, food and energy prices have risen. That's been a tax on consumers. But our thesis going into this year was that we were going to see normalization of policy. And the biggest reason is that the labor market is tighter than some, I just think. And so wage inflation will ultimately determine how far the Fed has to go this cycle.
So let's talk about some of those numbers. We get them monthly. There's a couple of different ways to slice and dice, and we got the quarterly numbers today. But it's not like this is usually the most followed thing. Maybe in the jobs report you're saying it's not so much about the headline jobs added every month, but look at the average hourly earnings.
Well, again, I think it's really important to calibrate. I mean, we have wages going up at least 4 or 5%. That's great for the consumer. It's good for the recovery. But what the Federal Reserve has to increasingly do is to ensure that those wage gains don't make it easier and easier and easier to raise prices for things that have nothing to do with the supply chain. And that's ultimately why we've seen the pivot from the Federal Reserve, and also why I think the bond market may be modestly surprised in the next 2 years that the Fed may have to go a little bit higher than it currently expects. Yeah,
to put it differently, what you're saying is, rising wages aren't the problem. The problem is they're not actually keeping up with inflation, and it kind of leads to this spiral and this chase where no one actually feels better off. Well, how many times do you think the Fed should hike this year? Is it 7? Because we're going to talk to Ethan Harris about that call next hour.
Well, it could very well be fewer than 7, but we've certainly been of the mind that the Fed was biased for action. I think the market is certainly directionally correct. I don't think 50 basis points will be likely. I think it'd be much more important to focus on forward guidance. We will see some choppiness in the economic data if our forecasts are right. But nevertheless, we're going to have an unemployment rate that by the end of the year will be closer to 3%. So if we think we see tightness in the labor market now, by the end of the year, we will see even greater tightness. So the Federal Reserve clearly has to lift rates. And I think, 5, 6, there may be a pause in there at some point because of volatility. But I think the trend is clearly on the upside.
So how far behind the curve are they? How fast do they have to move? How much do they have to move? And what do you say to those who worry that slowing the economy, which in some ways, could be the result, will be a worse outcome than what we're seeing right now?
Sure, and I think it's fair, concern from some. I think the Federal Reserve, again, may have to go as high as 3%. That's higher than what most economists are expecting. But they are doing it to preserve the recovery. And the worst thing that we could have is, wage prices continuing to increase, impacting consumer spending, leading to even more aggressive tightening down the line. That the Federal Reserve has to take, in my mind, the Fed funds rate, the short-term interest rates, at least above where they would want inflation to be in the long run, which is 2%. And we're well above that. Unemployment is also well below a definition of full employment by the end of the year. So I don't see how you have a Federal Reserve that's not going to at least 2% unless something has broken during the Fed hiking cycle.
But to go from 0 to 2% would be 8 quarter-point rate hikes. So, not
and again, sure. It's over and again, it's really over the cycle. I mean, you have to look into 2023. This is not going to happen overnight. It would not be, I think, the best course of action. This is about a normalization that's going to be a little bit quicker pace than we saw in the last recovery. Again, the last recovery, we had wage growth of only at best 2%. We now have 4%. So there is a greater tolerance of the economy on higher interest rates. And that ultimately is good news for the markets over the next several years, because that means inflation will eventually cool down.
Very interesting. I guess let me just ask you one more on this, Joe, which I'm starting to hear more and more about. Won't higher interest rates be bad for consumers on everything from, we're going to talk about student debt later, that's a little bit different, maybe more of it's fixed, but mortgage rates, borrowing rates, what's it all going to mean?
Well, I think it will mean, obviously modestly higher tens or even hundreds of dollars in certain payments, depending upon the loan balance. But for a mortgage holder, if the Federal Reserve engineers this right, and I think more than likely they will, it means long-term interest rates will not rise nearly as much as short-term. So this is good news for savers. It's ultimately also, it's not horrible news for those that have debt, particularly long-term interest rate debt, such as mortgages. So again, the worst thing would be the Federal Reserve not raising rates this year and then having to jack them up much more aggressively, and the interest rates, such as mortgage rates, getting really untethered. But I don't see that happening.
No, to your point, the curve's been flattening, and twos are up substantially, but tens not so much. Joe, it's great to have you. Thanks so much.
Thanks for having me.
Joe Davis joining us from Vanguard.